Hey Josh, I'm here. Yay. I'm going to go refill my water and get ready for class.
How you doing?
I'm doing better. Thankfully, because boy, I was concerned I had COVID,
Oh
but
yeah.
I I'm getting better on the antibiotics, and if it was a virus, I wouldn't be. So,
Oh, thank God.
oh man, it was boy, I felt rough. I couldn't breathe. I had shortness. I had an upper respiratory infection, earache, sore throat, the
Yeah,
cough.
that's scary because that's
It was
exactly like the symptoms of Corona.
exactly. And I was, oh, but thankfully, when the first day that I felt better was actually Tuesday afternoon. And I was so relieved. Oh, so let me go get some water. I'll be right back. Oh, and course content information. I have uploaded, I have uploaded the chapter 10 notes that are word processed. So go into course content information and look at those chapter 10 notes. Oh, I'm here. Okay. Before we get started, in course in course content information, I have uploaded some chapter 10 notes that I, word process because I, honestly was concerned that I had COVID, but because the only place I've been is the grocery store and the pharmacy, and I wear a mask and gloves. So, but anyway, I have responded to the antibiotics and I can breathe better and my earaches better and sore throats better. But ooh, it was nerve wracking. Um, I did word process, my notes that I talk about. So if you look in course content information, you will see the chapter 10 notes. There's also a decision tree for interest capitalization. You don't need that today. That is what we will cover on Tuesday. Okay. So before we get started in chapter 10, Let's talk about your number crunching experience with chapter 9. Obviously I pushed out because all we were doing on Tuesday was number crunching the 4 realm methods: the average retail, the conventional retail, the LIFO. Whoa, y'all hear? There's echoing. Why is there echoing? Did the echoing go away? Were y'all hearing that echoing, or was it just me?
Yeah, I was hearing it.
Okay, whew. I didn't know where it was coming from. I don't think anyway, it doesn't matter, it's gone. Is the number crunching, of which is what we would have been doing on Tuesday. But instead, y'all had to learn the number crunching on your own by looking at the illustrations, the end of chapter problems, and then doing the exercise that I had pushed out to y'all that had, 10 problems on it. So I looked at the grades on that. My 8 o'clock class, all but one person got 20 and one got 18. So they did really well on it. Y'all didn't do as well as the 8 o'clock class on it. And I don't know why. Many got 20. It wasn't like it was doomsday. But I wanted to talk about where were your issues with number crunching?
I would say mine was with like the price index on the LIFO.
Okay.
So like I got the first year, and then like the second year would kind of like, because of rounding sometimes, I got it right eventually, but my numbers would come out slightly off, or like I was kind of confused on the price index. That kind of threw me off, but I got it from there.
Okay, and you got there, when you got there, so you're talking about dollar value LIFO retail, the hardest one, the one that has more calculations.
Yeah. I got
right.
like the
And
first year.
did it end up being, Matt, did it end up being rounding problems or?
So at first I didn't understand it, but then at the end, it was just a rounding error. Like my retail percent was a little off.
Okay.
I was able to figure it out.
All right. One of the things that I want y'all to be on the exam, I am going to go through every question for every student, just like I did on the second exam, since it's, online. And if I see that you missed a problem, I'm going to check to see if it was a rounding problem. If it was a rounding problem, I will obviously give you the grades back, give you those points back, because I don't want you missing it because of a rounding problem. So don't worry about rounding problems on the final exam, because I promise you, I will look at every question for every student. For if you missed it, I'm going to look at it. Okay. So don't worry about the rounding. Now, did you understand the concept, both in LIFO retail and in dollar value LIFO retail, that you have to remember you're adding layers, and each layer is going to have its own cost to retail percent? Am I what? Somebody started to say, are you? Okay, I was hearing things, which could be because I've got pressure in both my ears.
We heard it too. It's just, I don't think they just didn't continue talking.
Oh, okay. Well, good. I'm not hearing things. Thank you. So that you're adding layers, and each layer under LIFO retail is going to have its own cost to retail percent. And then in dollar value LIFO retail, each layer is going to have its own cost to retail percent and its own index. So it was just a combination of DVL. Remember, you have to determine, did I add a layer this year or did I subtract a layer, just like you do in DVL? And then, of course, applying the cost to retail percent for each year. What is the difference, not in calculations, just in concept? What is the difference between LIFO retail and dollar value LIFO retail? I know we use an index in dollar value LIFO retail and we don't in LIFO retail, but why? Why do we use an index?
Sort of because you're basing things off of like the cost, and you have to determine how much of that cost is the base year cost, and how much of that is like from this year's actual inventory.
Right. That's how we calculate it. But the difference between LIFO retail and dollar value LIFO retail is, remember, LIFO retail assumes that prices are stable during the year. Where dollar value LIFO retail does not assume that prices remain stable, and not just during the year, during the process. That is the reason that we have the index, because we know that prices did not remain the same.
Okay.
Because remember, our layers are based on, did quantity change, not did price change. Remember in DVL, that was the reason that we used the index, was because we needed to know if we had an increase, was that increase due to quantity increase, price increase, or more likely a combination of both. So in dollar value LIFO retail, there is no assumption that prices remain the same because we're utilizing those price indexes. Okay. Now, some of the other issues that I got questions about were the employee discount. Most of that is just, we forget our, high school algebra. And so were y'all able then to figure out what the employee discounts were?
I didn't know if I got it right or wrong because like I ran out of checks, but you would take the other percentage. So if it was a 20%, then you take 80, and then you would divide that account by 80, and then you would subtract the original, correct?
Right. I think I sent you an email on that. Right.
Yeah.
So you would divide it, like if they got a 20% discount, then you would, if you got a 20% discount, then you would take the net amount, which is the amount after the discount, and divide it by 0.8 in order to get what the gross amount is, subtract the two, and then you could figure out the amount of the employee discount. So great, Edris. I'm glad that able to figure that out, and then looking at other problems. Were there any other questions about Chapter 9? Obviously, the number crunching.
I just had a question on the first homework problem in the part 2. I don't know if we have like time to do it right now, but it's basically like they gave, instead of giving you, they gave you the cost they gave you ending inventory at cost, and in most of all the other problems they gave you ending inventory at retail. So I was just kind of confused about how to.
Was the first one though that LCM problem? Is that the one you're talking about?
I'm not sure. It was in the part 2 of the homework. It wasn't on the quiz. Yeah.
Oh, not the quiz, but in the actual part 2 homework.
Yeah.
I would have to pull it up.
Yeah, I mean, we don't have to go over it right now. I might just schedule office hours or something.
David, can you email me that question, and I will take a look at the problem, and we'll email it back. And if it's an announcement that I need to put out about the I will look at how everybody did on it, and I will put out an announcement about that question, why they gave you it at cost versus retail.
They gave you the percentage. They gave you the cost to retail percentage. So you should have been able to calculate the cost. You should have been able to calculate the goods available for sale for retail and then work your way back up. But like,
Okay, yeah.
no
Okay.
matter what I did, I couldn't get the right answer.
Okay.
Like,
I will take.
Figured out that trick, but.
Okay, I will take a look at it. Some of it, again, let me go through because it was just due today. I did take a look to see. It looked like a lot of students didn't. I have some that did not do the part 2 Connect homework, and so I didn't know if some had forgotten to do the Connect 2 homework because of the assignment that I'd given for Tuesday. So one of the things that I did like at 10 minutes to 8 this morning, when I noticed that some more students than normal, like students that normally do their homework, didn't do the part 2 chapter 9 homework, I went ahead and changed the due date to tomorrow because I have to do it before the due date. Otherwise it goes into study mode and I don't have the ability to change it. So
I appreciate that.
Okay, so Nelson, you were one that didn't do the part 2.
Yeah, I don't know.
I
did the quiz and just forgot.
Yep, and that's what I assumed happened. So although Blackboard will still say that it was due today at 8, I do have it on Connect that it's due tomorrow at 8 because I had several that normally do their homework that didn't do it. So I assumed that it was just for that exact reason, Nelson, that you already had that big problem that I had given y'all to do. So you have until 8 o'clock tomorrow to finish part 2.
Awesome.
Okay, and Edris and David, those that are asking about it, I will go through y'all's, the one that I had assigned for Tuesday, the quiz, the double quiz as you call it. I will go through and see those that didn't get it 100% correct, what was going on, so that I can then address that issue to see if there was a common error. Okay.
Okay, thank you.
So I promise I will go through each one of them to take a look at it on chapter 9. Okay.
All right.
And then again, if there were rounding issues, then I will correct those rounding issues. If you got it wrong because of a rounding, then I will give you those points back. So I will take a look at both the chapter 9 part 2 Connect homework and the double quiz that I gave you because of canceling class. And I knew it was just going to be a number crunching day anyway. So I will go through and take a look at those individually. Okay.
Okay.
All right. Chapter 10, we start long-term assets. And chapter 10 is about initial acquisition of our long-term assets. And excuse me, let me get my breath a little bit. That's been a big problem, but it's much better. So I will look at, chapter 10 is about initial acquisition of long-term assets. Chapter 11 is about subsequent measure of long-term assets. So just like chapters 8 and 9 were about on inventory, chapter 8 was initial measurement, chapter 9 was subsequent measure. We see that same relationship with chapters 10 and 11. Initial measure in chapter 10 of long-term assets, and then subsequent measure in chapter 11. So the first thing I want to talk about is everybody able to bring up the notes that I had word processed, the chapter 10 notes in course content information? So if you can, pull those up. And we see that there are 3 different types of long-term assets. One is PP&E, property, plant, and equipment, that is tangible. And equipment, buildings, land improvements are all examples of these tangible assets. The common characteristic among these, obviously, is tangible. I can touch them. But when we get to learning in chapter 11 how to cost allocate, because we're using these long-term assets, since they're long-term, over a period of time. If I've got a piece of equipment that I'm using for 5 years, I want to allocate the cost of that equipment over the 5 years that it is producing revenue. We will learn the calculations of how to allocate the cost in chapter 11, but we learn in chapter 10 that cost allocation is called depreciation. And you're familiar with the journal entries with depreciation expense and accumulated depreciation. The other thing is that the cost that is capitalized for tangible assets are all the costs necessary to get that asset ready for its intended use. All the costs necessary to get that asset ready for its intended use. So let's look on page, look on page 517. And on page 517, we see an example of some typical costs that may be capitalized for equipment in illustration 10.4. And we see the cost that can be capitalized for when we purchase land. Oh, let me put this out. Land is not depreciated. Land is a tangible asset that is not depreciated, okay? Because land is just land and it's just going to be around. All right, so when we look at illustration 10.4 on page 517, some of the typical cost that we can incur to get that asset ready for its intended use. Equipment. Obviously, equipment, in order to get it ready for its intended use, is I want to push the on button and it works. So what does it take to get it ready for its intended use? And in the example that they have, they gave us information, obviously the acquisition cost itself, the purchase price. But in addition to the purchase price, they had to pay the shipping cost in order to get it there. Well, obviously I have to have the equipment at my place of business in order to use it for its intended use, so that cost would be capitalized. The insurance during shipping would be capitalized. Now, if I have regular insurance on my property, you know, just regular liability insurance, you know, insurance that I have in case, you know, something happens to it, we get a hurricane and it's, you know, all broken. So we have insurance. That type of insurance is expensed. That's just our regular liability and replacement cost insurance that we may carry on our buildings and our equipment. That insurance is just expensed every year. The insurance during shipping is just a one-time thing that we've got, you know, to insure it while it's in transit, so that it's protected and would be a one-time thing. That is the reason that insurance is capitalized. This special platform, you know, for this particular piece of equipment that Central Machine Tools purchased, was they had to build a platform for the piece of equipment to sit on. So that cost would be capitalized. and trial runs, like when you buy a piece of equipment, the manufacturer will come out and do trial runs and with an engineer, and you may have to pay the expense of that. So that would be capitalized because you need to make sure that the machine is working properly. So that cost would be capitalized. Another example that I generally give in class that of costs that may be capitalized would be most machinery I can't just plug into the same electrical socket that I do my lamp. That most machinery, you know, they've got a plug that's about this big around. And so if I have to have an electrician come in to change the electrical work for me to operate this machine, that would be capitalized, you know. So any cost that I have to incur in order to get that asset ready for its intended use would be capitalized. Now look at land. Land can be have some little different things to it that may be costs that we need to capitalize. And in the land, it said that we had $500,000. Sorry, I'm taking from my throat. $500,000 is my acquisition price. Then we have the title insurance. Does anybody know what title insurance is? When you purchase land or a building, you've got to hire a title company that's going to research the title of the property to make sure that you've got clear title to the property. A bank is not going to loan you money unless they know that you've got clear title to the property, to make sure that any prior owners of the property like don't have any liens on the property that have to be satisfied before you get clear title. So you hire a title company, they do a title search to make sure that there are no encumbrances on the property itself like liens, and then they will also give you an insurance policy saying we don't see any issues, and you actually have insurance in case on the title in case something does come up later that the title insurance company missed. So before you can acquire land or building, you need to make sure that you've got clear title. So that is a one-time expense that you have to incur when you purchase property. You'll see when you purchase your first home, all the different expenses you have acquiring the property, and one of them is title insurance. So that would be capitalized. The next thing they have is commissions. You know, when we buy building or property, there's usually a real estate agent involved, and we got to pay the commissions. That cost would be capitalized. Now, delinquent property taxes. This one is interesting. In the information, it said that $6,000 when they went to closing, that $6,000 they had to pay in property taxes, of which $4,000 of it was for delinquent property taxes. If the seller of the property has not paid their property taxes, then you cannot get clear title to the building or the building and the land, whatever you're purchasing, unless those delinquent property taxes are paid. So if the seller is delinquent and hasn't paid the property taxes, and to get clear title, you have to pay the property taxes, the delinquent property taxes are capitalized. It increases the cost of your property because only the property tax that you pay while you own the property is expensed. So property taxes that you pay while you own the property is an expense. Property taxes that you have to pay to get clear title are capitalized because you didn't own the property when these property taxes were incurred. but you just have to pay it in order to get clear title. So delinquent property taxes are capitalized. Ongoing property taxes are expensed. Now here they've also got cost of demolishing an old building. So what if I were looking for a piece of property that I want to build my corporate headquarters on? And I found the perfect location, but the perfect location, it has a building on it, but I don't want that building. I want to build my own corporate headquarters. So really what I am purchasing is my intended use is clear land that I can build a corporate office on. So the reason that the cost of demolishing the building that is on the land is capitalized is because my intended use is I want clear land. I don't want that building. So you would capitalize the cost of demolishing that building. Okay. Grading, cost of grading, that's not actually grading homework. Grading is leveling the land. These big machines come in, like say you had to remove trees in order to be able to build your property. Well, the cost of the tree removal would be capitalized. And say the ground isn't even, you need to grade the land in order to make it level. That's what grading is. And so obviously that cost would be capitalized because your intended use is to have land that you can build a building on. Let's look at exercise 10.3. And exercise 10.3 is on page 553. So exercise 10.3 is on page 553. And we've purchased land and building. And I also need to talk about something else before we get into 10.3. I can purchase land that has a building on it, and I only want the land. So I've got to demolish the building. I can also purchase land that has a building on it that I want to use. Well, there's just one selling price that I pay for the land and the building. And I have to have a way to allocate the purchase price to the land and to the building. Why would I need to have to allocate the purchase price if I'm going to keep the building? Why would I need to allocate the purchase price between the land and the building?
The building can depreciate and the land won't.
Okay, great. One reason is because land we do not depreciate. Buildings we do depreciate. So I can't depreciate the whole purchase price because part of the purchase price is to land. The other reason is that sometimes you can purchase, say I go in and I want to buy an old warehouse. And I say an old warehouse, a warehouse. And I go in and I pay one price for the warehouse. So I'm buying the land that the warehouse is on. I'm buying the building, the warehouse itself. And say the seller has some equipment in that building that they don't want. And so I'm purchasing the equipment also. So I would have to allocate that one purchase price between the land, the building, and the equipment. And I would need to allocate it among the three, one, because land is not depreciated, but also between the land, the building, and the equipment, because the equipment will have a shorter useful life for my cost allocation than my building will. I expect my building is going to last longer than my equipment. So we need to understand also how to allocate one purchase price to the different components that I purchase. This is called a lump sum purchase, which is on page 525 and 526 that you read. Do you remember in chapter 6, our revenue recognition, where we had the transaction price and we had to allocate the transaction price to the different performance obligations? And we did it based on standalone price. The concept is exactly the same. We're going to allocate the purchase price to the different components that we're purchasing based on standalone price. And that standalone price is its fair value. So in exercise 10.3, we're going to do two things. One is we're going to learn what cost should be capitalized. And then we also are going to learn how we allocate the purchase price to the different parts that we purchased. Okay, so I'm going to open up an Excel file and share it with you. I'm just going to open up a new one. And let me go in and share. All right, so there's my screen. And in the first one, in requirement 1, it says determine the initial valuation of each asset that is acquired.
I'm not sure we can see your screen.
Oh, you're not seeing my screen?
I do, but I just see a black screen.
Yeah,
So-
it's just a black screen.
Right, because we're going to work the problem together.
Oh, okay.
Yeah, we're going to work the problem together. So in exercise 10.3, I have the purchase price. So we're going to determine what has
Wait, your screen just says you're sharing your screen.
Isn't that
We don't see any. It's just a black screen and it says your name.
All right, well, let me try this again. I'm going to stop sharing. Share screen. What do you see now?
Now it's there.
Okay, cool. All right, so we're going to determine what is going to be capitalized and then what is going to be expensed. So they purchased, Samtech Manufacturing purchased land and building for $4 million. Obviously, our acquisition cost is going to be capitalized. They also paid, in addition to the $4 million, they paid for title insurance. Now, is our $16,000 of title insurance, is that going to be capitalized or expensed?
Capitalized?
Good, capitalized. They also had legal fees for drawing up the contract. Usually have an attorney involved in purchasing. And the $5,000 of legal fees, would it be capitalized or expensed?
Capitalized.
Good, capitalized. Then we've got prorated property taxes for the period after acquisition. When y'all go and you buy your first home, and I look forward to the day that y'all buy your first home. Oh, Edris, did you see that? I sent you the personal note. I'm so proud they bought their first home and they're going to be landlords too. So Edris lives in Chicago, where my son just closed on Friday on their first home. So since Edris is familiar with Chicago, I shared that personal information with him. So this is when you go to buy property, you've got to, they're going to collect, if you're buying it in September and property taxes are due in December, they're going to collect 9 months worth of taxes to distribute to the company, to the county or the state, usually the county, for their property taxes. So these are the prorated property taxes for the period after acquisition.
Expensed.
Good. So the property taxes after acquisition would be expensed. If these were delinquent property taxes, then they would be capitalized. Okay. And then we've got state transfer fees. Just for life information, state transfer fees are ridiculous. It's where the state has to transfer the owners on their property tax rolls, which doesn't take 2 seconds in computerized today. You think maybe they should charge you $50 at the most. No, it's in the thousands that they charge you just to transfer names on property. Anyway, I hate paying state transfer fees. That just, but anyway, it's a legal obligation. And so the $4,000, since it's a legal obligation to pay the transfer fees when you buy property, that would be capitalized. Okay. And then they give us some information about the fair value of the land and the building, of which is information that we'll need in order to allocate the amount that we have capitalized. So what is the total cost of the land and building?
4.4 million.
It is 4025.
Oh, yeah.
So 4,025,000 is the capitalized cost of my land and my building. So now I need to allocate this $4,025 to the land and the building, and we do it based on standalone price, which is the fair value. So I've got the land and the building, which are the two assets that we purchased, and the fair value of the land, its standalone price is 3.3 million. Does everybody see that in the information in the problem? So this is, how do we calculate what we call a lump sum purchase? Because we paid one price for two assets, so we need to allocate the cost between the two. Again, this should remind you of what you did in chapter 6. So what is the fair market value of the building? 1.1 million? Are y'all mad at me because I canceled class on Tuesday? So you're not talking to me? I know.
Right.
So the total fair value of what I purchased was 4.4 million. Did I get a good deal?
Yeah.
Yeah. So then we calculate what percentage of the total is the land. So equal divided by the total. And because I'm using Excel, I want to anchor the total so that I can just copy it down. Now we know that that would be 25% because this needs to sum to 100%, just like we did in chapter 6. Now, how would I figure out how much is going to be allocated to the land? What would I do?
You just multiply those percentages to the cost of the land that you paid.
Okay, good. I would multiply the percentage times my capitalized cost. And then I'm going to anchor my capitalized cost by putting the dollar sign in front so that I can copy it down. And the sum is $4,025,000, which is the amount that I wanted to allocate. So the land would be capitalized at, I would debit, it didn't ask you for the journal entry, but I would debit land for, I would debit BUILD, I would debit the building for the 1006, and assuming that I paid cash, it didn't ask you to do the journal entry, so it didn't tell you how they paid for it, but assuming that they paid cash, I would, credit cash. That's another problem. I don't know how I did that, but I did. I've got several of these. I would credit cash for the amount that assuming I paid cash for each one of these costs, I would credit cash. If I financed part of it, I would, credit note payable. So that would be the journal entry that would be done for the purchase. Does everybody understand how we calculated a lump sum purchase and allocated the purchase price to each component? Again, you can see the calculations of that. They had an illustration on page 525 and 526. You can see I've got the page references in the notes that I word processed for you. Now let's do requirement number 2. Requirement number 2 says, what if you paid $4 million for this land and this building, but your intent was you just wanted the land. You didn't want the building. So what cost would be capitalized for the land? So we know that the $4 million would be capitalized, the title insurance, the legal fees, and the state transfer fees. And then it said that in addition to those fees, that they paid demolition cost of $250,000. So I would have to capitalize that cost because the intent was to purchase just the land. And I also spent for clearing and grading the land, which we already know would be capitalized. I spent $86,000 for clearing and grading the land. Now they said that they were able to salvage materials when they demolished the building, that they were able to salvage some materials and sell them. You know, there are a lot of people that like old brick, copper wiring, slate roofs, you know, the slate that, you know, just different types of materials that you can sell. Does that, would that $6,000 that they got for selling the salvage material, would I debit cash and credit a revenue, or would I debit cash and credit land? In other words, does it reduce the capitalized cost, or is it revenue?
It reduces the cost.
Good, Nelson, it reduces the cost. So sale of my salvaged material would reduce the cost. And so the capitalized cost of the land would be
What did you say the journal entry for the salvaged material would be again?
we would debit cash and credit land, because you see it's reducing the cost of my land.
Yeah. Also, what do we make of the parking lot and the landscaping?
We're going to get there.
Okay.
So the capitalized cost of the land would be $4,355,000. If in requirement 1, I was keeping the building, then my capitalized cost was $4,025,000, and we calculated that $3,018,750 would go to the land, and $1,006,250 would go towards the building. Now, both in requirement 1 and they said that we purchased, we paid $82,000 to construct a parking lot and $40,000 for landscaping. Those would be under the category of land improvements. And so the land improvements would consist of the parking lot, which would be capitalized at, how much did my parking lot cost me? $40,000, $82,000. And we would also capitalize landscaping. Now, landscaping, I want you to make sure that you understand that when they're talking about the $40,000 of landscaping that they paid for, this is where they actually, you know, had the landscaping company come in and put in the permanent beds that they're going to plant the trees in or whatever. So this is like coming in and putting in that permanent landscaping. Now, every year, if they put in annuals instead of perennials, every year when they come in and they plant, as you see companies do to make their buildings look pretty, they put in the flowers in their annuals, so they put them in every year. That would just be an expense, okay? The landscaping that we're talking about is more of the permanent landscaping of the permanent beds that are put in, and any permanent foliage that they would put in, like palm trees. If we think of here in Florida, they last a long time and that would be capitalized. But the little plants of flowers that are done every year, that would be expensed, okay? So the parking lot and the landscaping are it's considered land improvements, okay? Would be considered land improvements and would depreciated. Land improvements are depreciated. Land is not depreciated.
But they don't go into the cost of the land, right?
No, they do not go into the cost of the land because they are depreciated. And so that's the reason that we did not include them in the cost of the land, or the cost of the land up here, or the building, is because these land improvements would be depreciated. Parking lots don't last forever, and landscaping doesn't last forever. Okay? So with respect to one of the types of long-term assets that we have, the property, plant, and equipment, they're tangible assets. The cost allocation is called depreciation. Land, though, is one of the tangible assets that is the tangible asset that is not depreciated. And the costs that are capitalized are all the costs necessary excuse me, to get the asset ready for its intended use. And then we learned how to allocate when we have what's called the lump sum purchase. We pay one purchase price for more than one thing, land and building, or land, building, and equipment. We learned how to allocate that lump sum price.
In that part too, when we were just interested in acquiring the land, we would just apply that whole purchase price with all the capitalization just to land.
Right, you would debit land and then credit cash or notes payable for however you paid for it. Yeah, so yes, it would just all go into land. All right, now let's talk about the second type of long-term asset, and that is intangible assets. Intangible assets lack physical substance. And what are examples of tangible assets?
Intellectual properties.
Tangible assets. Edris?
Intellectual properties.
Okay, intellectual property. What else?
Trademarks,
Trademarks.
copyrights,
Copyright.
franchise.
Franchise fee. Nelson, Matt, somebody say something else?
Patents.
Patents, good. And then there's another one that
Goodwill.
goodwill, okay, goodwill. Intangible assets are divided into two groups, those with a definite life and those with an indefinite life. Intangible assets that have a definite life are amortized. Now, what is amortization? That is what we call the cost allocation on intangible assets. Like tangible assets, we call the cost allocation over its useful life depreciation. Cost allocation on intangible assets is called amortization. Same exact concept in that it's cost allocation where we're allocating the capitalized cost over the life of the asset. We just call it different things. Depreciation for tangible, amortization for intangible, and when we get to natural resources, you're going to see that we call it depletion, okay? The concept is the same. It's cost allocation.
What are the two types called again? I'm sorry.
Those with a definite life and those with an indefinite life. You should see it, Edris, on the, I don't know if you have the chapter notes pulled up.
Yeah.
Okay, but it is one of the bullets, the last one where you see it says intangible assets are divided into two types.
Okay, thank you.
Oh, you're welcome. I'm just trying to show you to help with taking notes, you know, of where things are. So those with a definite life are amortized. Intangible assets with an indefinite life are not amortized, okay? Indefinite life meaning that it's going on into perpetuity. Now, what are some of the intangible assets that have a definite life? What about a patent? What is the life of a patent? You know, you do research and development. The research and development ends
That's
up
neat.
being successful and you and you purchase a patent, what is the life of a patent? Is,
Is it 20 years?
20 years.
yeah. Look on, let's look on pages, examples of your intangible assets are on page 522 and 523. And you read on page 522 about patents that the US Patent and Trademark Office, that patents have a 20-year legal life, a 20-year legal life. So we would amortize patents because they have a definite life. Their legal, the longest that their useful life can be is 20 years. Do you know when drugs go, you know how you can buy, when you go to the pharmacy, you can get generic drugs?
Yeah.
Well, and they're cheaper. Well, generic drugs are, once the patent has expired on a drug, then companies can then legally copy the drug, and that's what they call the generic drugs. They're just, the patent has expired on it. The company that originally created the drug through their research and development, they have 20 years to make money off of it. And then after that, other companies can copy it because they no longer have patent protection. So just, you know, where generic drugs come from. Now look at a trademark. When you license a trademark with the US Patent and Trademark Office, what is the number of years that the trademark is for?
10 years.
Good, Danielle, 10 years, okay, 10 years. But can you perpetually renew your trademark?
Yeah.
Yes. So because you can perpetually renew your trademark, it is considered to have an indefinite life. You think about, I say Golden Arches, that's a trademark. I say Golden Arches, what do you think of?
McDonald's.
McDonald's. Do you think that they renew that patent, trademark?
Yeah.
Every 10 years, certainly. If I say swoosh, what do you think of?
Nike.
Nike. So, you know, companies have their trademarks, and you can think of many of them that they're going to perpetually renew. You think of Mickey Mouse. You think that's not trademarked by Disney? The 5 rings. If I say the 5 rings, and I think they're blue, yellow, white, red, and black. What do you think of?
The Olympics.
Be good. The Olympics. You know, that is a trademark, and I'm sure they perpetually renew it because
So
you use that image because it has trademark protection. Edris?
if a company made like a crazy mistake
Yeah.
and like forgot, can you like take it and then they have to buy it back from you, I'm assuming?
No, they will sue you.
They'll sue you.
Yeah,
Okay.
the Olympic, you try and use, look,
I just didn't know if after the 7 years, like it was free game, like type of thing.
after
like,
what, the 10 years?
After that 7 years, is it free game?
What 7 years?
Isn't that what we said? 7 years?
I thought
I mean,
it
I'm
was
sorry. I wrote 7, 10. I don't know why I wrote 10.
10. Yeah, no, because they're going to renew it.
But that's what I'm saying. So what happens if they forgot to renew it?
Oh, well, then you're okay, but they're not going to forget to renew it.
That'd be crazy.
You know, there have been fraternities and sororities, you know, like will have Olympic games. And if you put like on a t-shirt, if you put those 5 rings, there have been fraternities and sororities sued by the International Olympic because of that. So yeah, you gotta be real careful about trademark. You know, the razors, Gillette, and you know how razors, like one has 3 bars and then it comes up with 4, you know, the whole thing. Gillette and Schick, or whatever that other company are that are major competition with one another, they love suing one another because they always saying that there's patent infringement, you know, on them. But anyway, so trademarks are perpetually renewed, considered to be an indefinite life, so therefore they would not be amortized. Now, one of the things with intangible assets that you see, that you read, and I have on the notes, is that only purchased intangibles are capitalized. Any internally generated intangibles are not amortized. Let's take a patent, for example. Pharmaceutical company. Pharmaceutical companies, or farm companies as we call them, they spend billions of dollars on research and development. Now, research and development cost, you read about research and development cost in this chapter. Is research and development cost capitalized or expensed?
Expense.
It's expensed. The reason that research and development costs are expensed is because as they're incurring the research and development cost, they don't know whether that R&D cost is going to end up with a successful patent or not. You know, there are billions of dollars that are spent on trying to find the cure for cancer, and they end up being unsuccessful. And of course, companies always hope that the billions that they're spending on R&D end up with a successful patent, but the facts are that they don't. I mean, that's why it's research, you know, looking for that right answer. So the FASB came out and said, because we don't know what R&D costs are going to end up with a successful patent, then it needs to be expensed. So R&D cost is expensed. So companies are spending all this R&D cost, and whoa, woohoo, we have a project that ends up with a successful patent. For example, we've got companies out there trying to be the first one to be able to patent the vaccine for COVID-19. And the cost of the patent that will be capitalized is only the purchased cost. What does it cost to purchase the patent? You know, companies have to hire a patent attorney in order to have their intellectual property protected. So the attorney fees that you pay for the patent attorney, the fee that you pay to the US Patent and Trademark Office, those would be capitalized. Any internally generated intangible assets are not capitalized, okay? So again, on intangibles, only purchased intangibles are capitalized. Internally generated intangibles are not.
So if you spend the next year and a half developing the vaccine, and then you spend a lot of money doing it, like you create the vaccine, but none of that process goes into the capitalized cost, just the subsequent process of like getting the actual patent for it?
Correct.
Okay.
So when you see patent on the balance sheet of a company, that is only the cost that they spent to acquire the patent itself. That does not include all the billions of research and development that they incurred to get to the patent, because that is expensed. Okay. Now let's talk about, this leads into, this is a good segue into the intangible asset goodwill. Goodwill is mathematically look on page 523. And you can see in the margin in the blue that goodwill mathematically is the excess of I'm going to go purchase a company, and I purchase the company for $50 billion. And if the fair value of the net assets that I acquired is lower than that purchase price, then I have purchased goodwill. How would you describe goodwill? What is goodwill? Why would you be willing to pay more for a company than the fair value of what you acquired?
I think sometimes they give an example of like the fact that the company has established culture and employees and processes, and basically the company is a whole working company and it's more than the sum of its parts.
Exactly. And it's the branding. You know, you learn in marketing about branding, a company branding itself. Have they established, it's their reputation also. You know, it's the culture of the company, it's the intellectual property that the company has, that it was internally developed, so it's not capitalized. They have established that the quality of their service is great. The quality of their products is great. It could be that I'm gonna pick on Walmart, but it could be that their brand is, I don't consider Walmart like good service and a good product place. You know, it's not, but they have certainly established that their brand is, you know, decent products at decent prices. So that is how they have branded themselves. That has been internally developed.
They're getting some good attention now with the crisis because they've been open, and Donald Trump mentioned them the other day, but I think their branding has like really fits this moment because it's like the fact that they're always there and they've always got so much product and so much availability and stuff.
Right, because one of the things that Walmart has done is their supply chain management is studied by other companies. So like Walmart, as David just said, has established their supply chain management. And of course, right now in this crisis that we're having with this virus is supply chain management, as we see with personal protective equipment, you know, the supply chain of getting it out, the mask, the testing and all. Developing good supply chain is difficult. And Walmart certainly has internally developed that.
Yeah.
So goodwill is all this internally developed attributes, good attributes that the company has established for themselves. Certainly, you know, something entrepreneurs want to do. You're an entrepreneur, you start your company and you hope one day to be able to sell your company for millions or billions of dollars. And how you do that is by creating your brand. The value of your company is to being more than the parts, as David said, the net assets that you are acquiring because of the reputation that the company has established for itself. Okay, so internally generated goodwill is not on the balance sheet. Because remember, only purchased intangibles are on the balance sheet. Internally generated intangibles are not. So any goodwill that a company is internally generating is not on the balance sheet. However, we do see companies that have goodwill on their balance sheet. How did that happen? How do some companies have goodwill on their balance sheet?
Is that from the purchase of a company?
Exactly. Remember, the only way that intangibles are capitalized is if you purchase them. So if you purchased a company and you paid more than the fair value of the net assets, then you have purchased goodwill. So if you see goodwill on the balance sheet of a company, then you know that that company has purchased another company that had goodwill. Thus, they purchased goodwill. Now, I keep saying that goodwill is the excess of the purchase price over the fair value of the net assets. How do we define net assets? This is something we learned in chapter 1. What is the definition of net assets?
Like current assets plus long-term assets? Or
That would be total assets.
Isn't it assets minus liabilities?
Assets minus liabilities is net assets, which also equals what, Matt?
Stockholders' equity.
Good, equity. Remember, another name for equity is net assets. Assets minus liabilities. Okay. So let's work a problem to make sure that we know how to calculate goodwill. And I've pulled out papers from my 8 o'clock class. So let's look at exercise. I'm sorry, again, I've got all of these. Oh, 10.6. So let's look at exercise 10.6 on page 554. And I'm going to share screen with you again. And I know that's not the right one. I'm going to see if I can, you can see all the ones that I have. Okay, cool. So in exercise, can you see the screen? Am I sharing the screen?
Not right now.
Okay, don't know why. Stop share, share screen, and now can you see?
Now,
Okay.
yeah.
So in exercise 10.6, they paid $17 million for the company. Now they give you the assets and the liabilities that were purchased. They give you the book value and the fair value. For calculating goodwill, am I interested in the book value or the fair value?
Fair value.
Good, the fair value. Because we are acquiring assets and liabilities, and I am acquiring them at the fair value, okay? So we see that the fair value of the current assets is 7.5 million, of the property, plant, and equipment is 14 million, and of other assets is 1.5 million. The fair value of my current liabilities is 4 million. Notice I subtracted it because net assets is assets minus liabilities. And I subtract the fair value of my long-term debt. And then when I sum those, I end up with the fair value of the net assets as 13,500,000, which is just the sum of the assets and liabilities acquired. I paid 17 million. So the amount of my goodwill would be $3.5 million. My journal entry, I would actually, now I don't know, of course my current assets would be cash and accounts receivable and inventory. And so I would debit each one of those that sum up to 7.5 million. right now they didn't ask you to do the journal entry, but I will show you the journal entry. But I will have to use the categorical name since I don't have the individual current assets and property, plant, and equipment. So I would debit my assets, and then I would credit my liabilities. Now, I saw somebody did a chat question and then it goes away when I'm sharing screen. Let me see if I can bring my chat up again. Oh, there we go. Thank you. Oh, okay. Nothing to show. Okay. Never mind. Y'all got it. So y'all can see it all now? Is everybody seeing the screen?
I think it's frozen.
I think it's frozen.
Oh, it's moving on my end.
Yeah, the only thing we see is the goodwill. And then it doesn't show you typing or moving.
Oh, okay. Well, let me see if I'll stop sharing again. Thank you for letting me know that. And how's that?
Yeah.
Okay, sorry about that. So I, will debit the assets that I got. Of course, I'll credit the liabilities that I got. Now let's see if my journal entry balances. Oh, wait, before I do that, we would also credit cash. How much did we pay for it? 17 million. All right, so I would credit cash for 17 million because that's how much I paid for it. Now let's see if my journal entry balances. How much am I off?
3,500
33,
or 3.5 million.
3.5 million, right? What is that 3.5 million?
That's
Goodwill.
yeah.
Good, that's my goodwill. So I would debit my goodwill, and now I am balancing. Okay, so here we see where we have a purchased intangible goodwill because we paid 3.5 million more than the fair value of our net assets. Okay, so internally generated goodwill is not capitalized. Purchased goodwill is because it's an intangible asset. Okay. Everybody good on exercise 10.6? Goodwill is considered to be an intangible asset with an indefinite life. With an indefinite life. So now we have covered the concepts of the second type of long-term asset that we have, the intangible asset. Okay, so we had property, plant, and equipment, which is a tangible asset, an intangible asset. Now let's look at natural resources. The cost allocation, as I already said, we'll call depletion. And we will learn, how to do depletion, amortization, and depreciation to calculate the amounts in Chapter 11. For natural resources, there are 4 types of cost that are capitalized. So I want y'all on page 518, 519, 520 will be the pages that we are looking at. And the 4 types of cost that are capitalized, you see them on the note page that I gave you. So capitalized cost includes the acquisition cost, the exploration cost. Exploration cost is, I'm from Louisiana, so I buy some land that I think has oil and gas on it. And the exploration cost is, sorry, I'm running out of breath. The exploration cost is I need to hire geologists that, do their thing, whatever they do, to determine how much and where the oil and gas veins are on the property. So they're exploring to find the natural resource. If it's a coal mine, they're exploring to find out, where the best veins in the land for the coal and how much they estimate would be there. So that's exploring it. Then there's development cost. Development cost, I've now explored and I found that there's oil and gas on the land. So now I need to develop the equipment that it's going to take to extract the oil and gas out of the land. Have any of you ever seen those pumps? We call them Christmas trees in Louisiana. And not just in Louisiana, the whole oil and gas industry does. That they build to, and the the oil and gas comes out of, and then they have the pumps that are doing it. Well, that's the development cost. If you can think of a coal mine, the tunnels and the rail that has to be done in order to get the coal out of the land, that would be the development cost once they have explored where the natural resource is. So we've got acquisition cost, exploration cost, and development cost. The 4th cost is restoration cost. Restoration cost is cost that the companies are going to have to pay in the future. The Environmental Protection Agency, the EPA, says that companies have got to remediate property so that it is livable. They can't just abandon a coal mine and then just leave it as this desert of polluted land. They've got chemicals that have, infiltrated into the land, from, I'm sure, filling up the diesel in trucks has gone into the land. Y'all all know all the issues that have come about before we had remediation laws years and years ago, where people got cancer for building houses on land that was not remediated. So many, many years ago, the EPA requires that companies have to remediate the land. Well, obviously, restoration cost, restore the land to livable, is going to be paid in the future. But the cost of restoration or remediation, they call it restoration, but the cost of restoring or remediated the land has to be capitalized when you purchase the land. So this is cost that we're going to pay in the future that we have to capitalize today. So if today I'm incurring costs that I'm going to have to pay in the future, what have we created? So pardon me?
Liability?
Good, we create a liability because a liability is an obligation that we have to pay in the future. So a liability is created for the restoration cost. And what do we call that liability?
Asset retirement obligation?
Asset retirement obligation, ARO. So we have to we have to know what restoration cost, how do we calculate the amount that we need to capitalize for restoration cost, which is then creates my liability, my ARO liability. If you look at illustration 10.6 on page 519, and then it continues to page 520. And all semester long, I've asked that you critically read these illustrations. And when you, in other words, recreate with your calculator the problem. So on page 520, you see from the information that was provided on page 519 that the capitalized cost, this was a coal mine, that the capitalized cost is $2,768,360. They have the acquisition cost of $1 million, exploration cost of $800,000, development cost of $500,000. And then they have restoration cost of $468,360. Where did that number come from? Can somebody explain to me how that number was calculated? Did you recreate it? When you read this chapter and you saw that 468,360, you should have said, oh, wait a minute, sorry, I got ringing in my ears. Oh, I'm sorry, that I've got earache with all this. Anyway, that the 468,360, did you recreate that 468,360 so that you could understand what you read?
Yeah, it has to do with the present value, right?
Right, the present value of what?
Of the amount you're going to have to pay in the future.
Okay, which was based on?
Well, it's based on the probabilities.
Good. So we first had to calculate what is the probable amount that is going to be paid. What was the probable amount? This project, I'm sorry, I'm running out of breath because of this upper respiratory infection that I have. This project, they thought that they could extract all of the coal in 3 years, okay? And what is the probable amount that they expect to have to pay at the end of the 3 years?
$590,000.
Good, 590,000. How was that number calculated? So they calculated that the probable amount was 590. How'd they calculate 590? David, let me see, Anna. Anna.
Yeah.
How did they get the 590? Let me get other people participating.
Is it the cash outflow times the probability?
Okay, great, Jordan. It's the cash outflow times the probability, and then they summed them up. Okay, if you look on page 519, they had to get some engineers and geologists together in order to figure out what possible restoration costs were going to be. And they said, well, there's a 30% probability that it's going to be 500,000, a 50% probability it's going to be 600,000, and a 20% probability it's going to be 700,000. And if you look on page 520, they show you that when you multiply the probabilities by the cash flow and then sum them up, you get the 590,000. But they didn't capitalize 590,000. They capitalized 468,360. The 590,000 is what they anticipate that they're going to pay at the end of 3 years. We know that if we're going to have cost across time, that we must use time value of money concepts. So if I estimate based on probabilities that I'm going to pay 590,000 3 years from now, then I must calculate the present value of that 590,000. So let's work a problem. Let's look at exercise 10.4. Exercise 10.4 is on page 553. Okay, it's on page 553. Now I'm going to share screen again. And do y'all see a blank Excel sheet?
No.
Oh,
Seems
man.
It seems like it's making you do it twice every time. I don't know why.
I don't know why. Share screen. Is it there now, a blank Excel?
Yeah.
All right, so in exercise 10.4, we've got Jackpot Mining Company, and they purchased a copper mine, and we know that we've got acquisition cost, and the acquisition cost, how much did they pay for the copper mine?
1 million.
1 million. And then they said that they spent an additional 600,000 to prepare the mine for extraction. So they combined the exploration and development cost together. And that's okay. We don't have to have, one for exploration and one for development. And the exploration and development cost was 600,000. Now we need to know what the restoration cost is that is going to be capitalized for this copper mine. So let's calculate our restoration cost. They had 3 different probabilities. And the first one was that there was $300,000 and the probability was a 25% probability. I don't want to do that. I want to do this as comma, and I want to do this as a percent. So we know that there's a 25% probability of the 300,000. A 40% probability for 400,000 and a 35% probability, which obviously my probabilities need to sum up to 100%. Now what am I going to do?
Multiply them.
So I need to multiply the cash flow times the probability. And we get that the probable amount that is going to be paid at the end of 4 years, because they estimated that it would take them 4 years to extract the copper. So the probable amount that they're going to pay at the end of 4 years is $445,000. Now, is that the amount that I capitalize? Is that the amount that I capitalize?
No.
No. Good, Josh. What do I need to do?
Sorry, what problem are we on real quick? What number is it?
10.4. Exercise 10.4 on page 553.
We have to do the time value of money.
Okay, good. We need to calculate. What am I going to be calculating? What am I looking for?
Present value.
Good, present value. Now I'm going to hard code here. So I'm going to say equal. I'm not going to use the input, which we know we should do, but present value equals, that was a plus sign, equal PV, open parentheses, and my rate. What did it say my rate was? The rate for this company, the risk-free adjusted rate.
10%.
10%. Remember in Excel, you put in 0.1. If doing it in a calculator, you would put in 10 and then hit I. So 0.1 is my rate. What is my number of periods? How long was it going to take them to extract the copper?
4 years.
4, good. How much am I going to be paying each year? None, right? How much am I going to pay in the future at the end of the 4 years? That 445,000 that we had calculated using our probabilities. And then this is an ordinary annuity. So my present value is 303,940.99. So my restoration cost, if we round, is 303,941. So the total cost, so the capitalized cost of the copper mine is $1,903,941.
Are exploration and development costs typically together like that?
You know, it depends on the problem. Some problems give you both.
They are their separate costs. Like they can be their own separate costs.
Oh, absolutely. Oh, yes.
Making sure.
So it just depends on how the problem, whether they combine them or give them to you separately. Okay. But there are 4 costs that are capitalized: acquisition, exploration, development, and restoration. Okay. Now on page 520 in your textbook, you saw below, once they calculated what the cost that were going to be capitalized was, they talked about accretion expense on the restoration cost. Okay, so on page 520, you saw the accretion expense. If you think about your general ledger account, your ARO, your asset retirement account, because my journal entry, let's just go ahead and do the journal entry. My copper mine, I would debit for the 1,903,941. And then I would credit cash for the 1 million acquisition and the 600,000 of exploration cost, assuming I paid cash for it. If I borrowed money, I'd credit notes payable. And then I would credit my ARO, asset retirement obligation, which is a liability for the 303,941. Okay, again, that's a credit, so I need to indent. So that would be the journal entry. So my ARO general ledger account currently has a balance in it of 303,941. At the end of the 4 years, what should the balance of the ARO account be?
45.
Good, $445,000. So how I'm going to get the ARO account from 303,941 to the 445,000 is we will have accretion expense every year. And the formula for calculating the accretion expense is the carrying value of the ARO times the rate times time. So my initial carrying value is this present value. I know it's 303,941 rounded. We wouldn't round in real life, but is the 303,941 is my initial carrying value. My accretion expense for years 1, 2, 3, and 4 would be the carrying value times the 10%. That was the rate that was used to discount the restoration cost, times time. Now in this problem, they didn't give me the date that it was purchased, so we'll assume it was purchased on January 1st, so my times time would be times 12 over 12. So my accretion expense for year 1 would be $30,394.10. And I would debit accretion expense for the $30,394, and I would credit the ARO account for the same amount. So now the balance in my ARO account has increased by the amount of accretion expense. So my carrying value now is going to be 334,335.09.
Was that accretion expense given?
Pardon me?
Was that accretion expense given?
No, I calculated it. Carrying value times the 10%, and then
Okay.
times time, which would be 1 since we assumed it was purchased on January 1st.
And the 10% is given?
Yeah, remember when we calculated the discount? When we calculated the present value?
Yeah.
Remember the rate they gave us was 10%? So the rate that you use to calculate the present value, you use that same rate to calculate your accretion expense. Now, because I used formulas, I can just copy this down. And my accretion expense for year 2 is 10% of, my new carrying value. And at the end of year 4, the carrying value, meaning the balance in my ARO account, is $445,000. Does that number ring a bell?
So this is kind of like interest payable on a note, except it's going into the ARO expense or the ARO account directly each time.
Yep. This is just like this is just like to calculate interest on a bond. Do you remember that in principles? We're going
Not
to be
exactly.
doing this on a non-interest bearing note on Tuesday also. So that remember this concept: carrying value times rate times time. Now on this one, again, they didn't give us the date that they purchased it. So we're assuming January 1st. So in the first year, I don't have, my times time is 12 over 12. If I had purchased it September 1st, then it would be times 4 over 12 for the first year. Okay. So the 445,000, I did my accretion expense for each of the 4 years, and then the ending balance in my ARO liability account, my asset retirement obligation account, which is a liability, is 445,000. Does that number ring a bell? Do you recognize that number? What did we calculate as the probable amount that was going to be paid at the end of four years? $445,000? Can I get some kind of reaction from?
So the 445 is basically just broken down into the 4 years. So we see how much is divided into each year. So like the accretion is going up every 4 years. So it's showing us how we got from 303 to 445.
It's showing how we got from the present value to the future value.
Okay.
Exactly, Josh. Good. So the 445,000 was what we had calculated was going to be the probable amount that we were going to have to pay at the end of 4 years. And so in order to get my ARO account up to that probable amount at the end of the number of years that they expect to extract the natural resource out of the land, we have accretion expense for each year. It's kind of like interest expense, but we didn't borrow money, so they don't call it interest expense.
So it's 10% times the carrying value times 10, you said? Or what is it? Times time?
Time, just like we calculate interest.
Okay.
Okay. And this one, each year was a whole year. So my times time was times 12 over 12, because we assume they didn't give us the date. This problem didn't ask us to calculate accretion expense, and none of the problems do. So that's the reason that in exercise 10.4, I'm extending it to show you how they calculate accretion expense, because there's not an end of chapter problem that asks you to do this, and you need to know how to do it. So the illustration's on page 520, and we just applied it on exercise 10.4, although they didn't ask us to do it.
If it came to the end of 4 years and it turned out that the amount they needed to pay was not 445,000, but rather 400,000 or one of the other numbers, they would make an adjusting entry then for like the additional expense or the lesser expense.
Right. I believe I uploaded the ASC2 project, your second codification project. And let me go into, I have so many of them, I don't know which one I uploaded. Has anybody tried it yet?
Not yet.
Not yet. Okay.
Yeah, this weekend.
Let me stop sharing the screen, and I'm going to go into Blackboard, And I'm going to go into other assignments.
When is the second project due again? I'm sorry.
I think on the 21st, April 21st.
Okay. Thank you.
You're welcome. Yes, the AS2, David, that I've given y'all to do is on the ARO and interest capitalization, which are both in this problem. And you can read in the ARO section about what happens, because we're 100% positive that it's not going to end up. Let me get back to y'all. 100% positive that it's not going to end up being the exact amount. Number one, we're dealing with probability math, so we know it's not going to end up being the same amount. In that AS2 that you're doing, you can read on how do we handle it when it's different.
Okay.
Okay.
I got a question about the ASC2. So like, is it going to be the same type of setup as the first one where we're like going through and like really quoting each of like the codifications that we look
Yeah, it's
at?
going to be like the third, the last question where you had to actually answer the research question with proper citation.
Okay, cool. Thanks.
You need to answer, the research question.
And quick question about like the ASC and just in general. You're not like looking for like big long answers, right? Like
No,
okay, just making sure.
Nope. Nope. Just however many sentences it takes to answer the question. Nope.
Yeah, I was worried about that too. On the last one.
No, don't just answer the question, and the answers are there, and you can do, just lead in with your own words, and then you can copy and paste from the codification itself. On the CPA exam, you're required to research in the codification on the CPA exam. And to answer the questions, you can copy and paste from the codification. But I also want you to lead in with your own words, because the readability of the codification is at graduate level reading. So I want you to make sure that you understand what you're reading and can actually put it in English instead of FASB foo-foo wordings, foo-foo language, okay? So today we covered the capitalization for property, plant, and equipment, intangible assets, and natural resources. What we're going to cover on Tuesday are, and if you look at the chapter notes pages that I've given you, is the ways that we finance long-term assets. The only thing that's new here that takes calculations are when we have non-interest bearing notes. So we will spend time learning the calculations on non-interest bearing notes, very similar to this accretion and restoration, calculating present values. And then, anyway, you'll see on Tuesday, very similar. So make sure that you read and understand page 527. That's on your non-interest bearing notes. Then we're going to get into self-constructed assets. And the big thing on self-constructed assets is calculating the amount of interest that needs to be capitalized. The calculations on it are a lot of calculations. In course content, where you found the chapter notes, there's also a decision tree. And the decision tree is what we will use to help us understand what calculations we have to do when. So Tuesday is going to be a big number crunching day. If you can look at the page 535 and 536 and look at and re-perform the calculations, the capitalized interest calculations, it will greatly help us with going through the calculations on Tuesday, because you would have been exposed to the calculations themselves. How do I calculate the weighted average accumulated expenditures? What interest rate do I use? How do I calculate the weighted average interest rate of other outstanding debt? I mean, it gets a lot of parts to the calculation of it. So that's what we'll be spending our time on Tuesday doing, are the calculations. And again, I'm also going to go through the Chapter 9 work that you did to see if there anything that you got wrong because of rounding issues. I'll correct that. And then all because of Nelson, no, not just Nelson, there were more of those that did not do the Part 2 Connect homework because you forgot, because I had y'all doing the other. It's due at 8 o'clock tomorrow. Okay?
Oh, I wish I knew that. I'm not gonna lie. I pulled an all-nighter. I went to bed at like 7 a.m. to do all the connect.
I looked at it, Matt, at 10 minutes till 8 this morning. And the only reason I looked at it was to see how well y'all did, to see if you understood the material. Then when I saw that some had not done it, then I was like, and I understood possibly why. So I didn't have the ability to.
Did you see mine was like just submitted? Like I submitted it at like.
No, I hadn't looked at submit times.
Oh.
But maybe I'll do
one.
something for those that got it 100% right and submitted on time. Maybe I'll give you a point or two.
That'd be nice.
For pulling all-nighters and doing it.
Exhausted.
Yeah, but it won't cost anybody that didn't do it. I'm not going to take away points for it being late, but on those that did it on time, maybe I'll add a point.
Well, some extra. Yeah.
Something extra. We call it lanyap in Louisiana.
I'll take it.
We'll take lanyap. Lanyap means something extra in Louisiana. So, all right. So we'll see y'all for lots of calculations on Tuesday. Please, look over it so that you are familiar when we get into the calculations of the terminology and the words used, and look at that decision tree.
What was there a page for the calculations that you had mentioned?
Capitalized interest is, it starts on page 535, and you get into calculations on page 539.
So those are the ones to practice to be prepared for Tuesday?
Yeah, on page 539, they just have like the first year, and we're going to get into the second year of what happens and all. But yeah, if you can understand 539, start there.
Okay.
Okay. All righty. I will see y'all on Tuesday.
Real quick. Sorry. Are you gonna have office hours next Wednesday? Or like?
Yeah, I will go. Yeah, thank you. I will go ahead and create that in Sign Up Genius right now.
Okay, cool. Thank you. I just wanted to go over 9.
Oh,
that was
and also, I know people are going. Also, the day before your final exam, I'm just going to have open office hours on Zoom. Okay, so I will have that. But yeah, I'll go ahead and create them now, Edris.
Thank you so much.
You're quite welcome.
Yep. Have a great day.
Thank you. You do the
Thank
same.
you so much, and hope you're feeling better.
Oh, I am. I actually got through 4 hours of talking, so yay. So
That's good. Yeah, just with what's going on right now, I'm
I was scared to death. I had all the symptoms of it. They're the antibiotics are getting me better, which means it's not a virus. Yay.
Very good. Very good. Yeah. Rest up. Have a good weekend. See you, Professor.
You do the same. Bye-bye.
Later.